What's up, everybody? Welcome to this week's episode of the Weekly Wrap. Today is episode 11, and I'm actually recording on Monday, September 19th, so there will be no Daily Dose episode today. I do apologize for the lack of videos the past couple of days. I've been out of town for a friend's bachelor weekend, so that's why I wasn't able to make any videos over the last couple of days, but I wanted to put out the Weekly Wrap episode today, and then I'll pick up with the Daily Dose videos tomorrow. So if you like this type of content, be sure to subscribe here on YouTube and follow wherever you listen to podcasts. There will be an episode like this every week that is a little bit longer, goes into more in-depth, more analysis, and then every weekday that the stock market is open, I will release a short video just recapping what happened that day. So be sure to subscribe for that. But let's get into this episode. So in this episode, I'm going to be talking about how history doesn't repeat, but it does rhyme. So we have to understand history to be able to make better predictions for what's coming ahead, especially in a market like we're in right now. So we're going to be making some market comparisons to 2008 and some other markets, why it's a good time to be a long-term investor. We'll be talking about when the Fed might pivot, how markets do following huge sell-offs, and we'll be talking about how Bitcoin still has a lot of room to fall and a lot more. So let's go ahead and get into the episode. The first thing I want to cover is retail sentiment. So this is a chart I like to look at every week to see how it's changing. And one thing that surprised me this week was that it was the first time in a few months that the market was actually down, and it was down a lot, but sentiment actually ticked up. So to me, that indicates that people are looking for a bottom, that they're thinking that we could be getting closer to a bottom in the market, and that's why they're becoming more bullish, because typically during this market, the sentiment has pretty much followed whatever the market's doing. So if the market's going lower, then the market is getting, or then the retail sentiment's getting more bearish, and vice versa. This chart also has the historical averages on it. So near a 1-year bullish high, the average is usually a 48% bullish sentiment. And during a 1-year bearish high, it's usually at 59.4% bearish sentiment. We were almost there last week, September 7th. We were at 53.3% bearish sentiment. So that was really low. That was a low for the year, actually. But it ticked up this week, and I just thought that was interesting. So retail investors might be putting in more money thinking we're closer to a bottom. And whenever bullish sentiment goes higher, that's a good bear thesis for why the market might actually go down. So I want to talk about pessimism versus optimism when it comes to correlation with stock markets. So this is a chart from Sentiment Trader on Twitter that they put out, and every time that the excessive pessimism has exceeded 0.65, they correlated that with a point in time on the market. And as you can see, that point is usually near a bottom. The only time that didn't happen was in 2020 when the market spiked a lot lower following this reading. But then the market recovered in just a few months past that point and beyond, as you can see from the chart of the S&P 500 from 2020. We just hit that mark again here in 2022. So usually these points, if you look back to the early 2010s, you'll see that it comes before a bottom, but not before like some capitulation. So usually there will be a little bit more selling before we actually get to the bottom following this reading. But then the market then will make a bottom after. That's what has happened in different points in time. Obviously, this market is a little bit different from those in the sense that the Federal Reserve is actually going to be tightening quite hard while the United States is going through a recession, and we haven't seen that before. Usually the job of the Federal Reserve, they make the markets looser during a recession, but because of this problem that we're having with inflation, they're actually going to have to tighten the economy while we're going through a recession, and so the market could definitely behave a little bit differently than it has at these other points in time. So I also wanted to give some general economic overview, kind of gauge where we're at. This chart overlays the past 40 years of the S&P 500 overlaid with the historical average for the price to earning, and then it gives a bunch of price to earning averages with it. So the 20-year average right now is actually 12.8. The 40-year average is a little bit higher, but it would still be below where we're at right now. So if you look at where we're at on the S&P 500, if you look right here, so like we're kind of in between this line right here, the third highest, and this line right here, the fourth highest. So that would be between 20 and 18. So we're sitting at like kind of a 19 price to earnings ratio. The 20-year average is 12.8, which gives us a lot of room to fall. That might seem a little bit low, considering what we've seen the past couple of years, but really the average for the last 40 years should sit somewhere between 14 and 16. So even with that, we're still overvalued when it comes to the P/E, which is really the indicator that most people like to use, is just like a basic indicator to see if the market is fairly valued, overvalued, or undervalued. So even with the heavy selling that's been coming throughout the summer and the middle of September, we are still overvalued by that metric on the stock market, which could be a headwind for anyone hoping to see a bottom in the market anytime soon. If you want to buy at lower prices, you'd want to wait for this to come down to get a cheaper price, a fair price on whatever you're looking at. But if you're a long-term investor, it's always good to just dollar cost average during times like these to get the average of all the prices that you're going to see in the next couple months or next couple years, because you don't know what's going to happen. You don't know if the economic situation is going to get better or worse over the next 1 to 5 years. So it's better just to average in, especially if you have a long time horizon. You build a base during this period where prices are lower, and then no matter what happens over the next 20 plus, 30 plus years, you reap the benefits of those investments. So another thing I want to talk about is real wages. And for the first time in a number of years, they're actually falling year over year for consecutive years in a row. So when real wages are falling, this is really hurting the working class the most, right? Because the wealthiest people in the world, they don't rely on wages for their income. They rely off their assets for income. So when wages are falling, that's bad for one class of people. So it can deepen the wealth gap. It's bad for wealth equality. And in general, it's just bad for humanity. We see over the course of all of human history when there's a huge disparity of wealth between one class to another. That's generally when you get your most violent times in human history, where you get your regime changes and changing world orders. That's generally when this happens. That's kind of something that causes that. So from 2020 to 2021, they fell year over year in most major countries, and from 2021 to 2022, they fell again. So that's not good if you're in the working class. That means you have less buying power from the money that you're getting, even if you're getting a raise. In these countries, I can pretty much guarantee it's not keeping up with inflation. So even if you're getting a raise, you're actually getting a real pay decrease, and that's not good for most of the people in the world, because most of the people in the world fall into this working class. So one way to kind of offset this is to buy assets, so you don't have to rely on wages as much for income. And when assets are cheaper, that's actually when it's better to buy them. So a time like now could be a good time to invest for the long term, and maybe at some point later in your life, you can switch out that income from a job, a wage, to income from an asset, which should increase over time. So I also want to talk about the correlation between corruption versus real GDP per capita. So this chart on the y-axis, you see the corruption index. So the higher on the index you are, the less corrupt your nation is. And on the x-axis is the real GDP per capita. So the farther right you are, the higher GDP per capita you have. So you can see there's a pretty linear correlation here with countries that are most corrupt would be Russia, Mexico, the Philippines, Turkey, Indonesia, India, Egypt, Argentina, Brazil, China even, South Africa, Hungary. So those would be your most corrupt countries. And you can see that they're the lowest at the farthest to the left on the real GDP per capita. So their countries actually see less growth than the rest of the world, even though that the leaders are corrupt and trying to create more wealth for themselves. And you'll see the countries with the least amount of corruption. So those would be New Zealand, Finland, Denmark, Singapore, Switzerland, the Netherlands, Luxembourg, Norway, and Germany. Those companies actually have, also you could put Ireland in there. They actually have the highest GDP per capita. So you can see that they're farther to the right and they're up high here on this chart. And then the United States actually is falling. So we've actually slid down quite a lot on the corruption index. So we're kind of in that middle to high group as far as corruption goes. And our GDP has actually fallen as well. So a lot of these countries that are less corrupt than us, most of them actually, you can even see Japan, Hong Kong, the United Kingdom, although their GDP is not as high as ours, our GDP is also falling at the same time. So Ireland, Luxembourg, the Netherlands, Switzerland, Singapore, Norway, they all have higher GDP than the United States per capita, and they also are less corrupt government-wise. So this chart just kind of shows also that when people become corrupt at the top and what they're trying to do at the end of the day is create more wealth and power for themselves, they're actually hurting the entire country. So they're kind of going backwards. And that's something you have to be careful about. Obviously, there's nothing that we can do about this. There's nothing that you can do individually to decrease corruption at a large scale in the U.S., but it's just something interesting to look at. It was a chart I saw this week that I kind of just wanted to throw in the video because I thought it was cool. So this is something I want to look at. So the past couple of weeks, we've been looking at bull case and bear case charts as far as like correlation goes from the market this year to markets in the past. And we've seen some high correlations with markets that have a bottom and then bull higher. They have a big bear market rally, and then they come back down to the bottom again, test it, and then move higher from there. The reason I want to focus on this chart is because it's a little bit more updated, and a lot of people are kind of making the case that this should be like a 2008 style bear market. Now, obviously, it would be different because the circumstances are a little bit different now than they were then, but there are a lot of parallels to that market. So if you look at the S&P 500, it's kind of in lockstep with what we were doing in 2008. You can see that this would correlate with the June low right here, and then we had a really big market rally through the end of June and July. And now in September, we've kind of been falling back down. So that's definitely in line with what we saw in 2008. What we'd expect next, if it continues to stay correlated with this chart, is a little bit more selling, probably going into the Fed rate hike. And that'll either be between 75 and 100 basis points, most likely. So we'd see maybe a little bit of selling. Maybe it spikes down hard after the rate hike and then starts to recover after because we sold off really hard. And then after that little bit of a recovery, then we'd kind of see the beginning of another huge sell-off, which is what happened in 2008. And then another bull market rally, and then it continued lower. So obviously you can't look that far ahead, but you can look to see what correlations we could maybe stay in line with in the near future, and kind of see if that lines up with any upcoming events. So like the Fed is coming out to raise rates, that could definitely be in line with something like this, and then a sell-off. So that's kind of what I'm looking at right now. Also, you have a lot of algorithms that control a lot of trading on the markets, and they look at things like this. So the reason that markets can be so correlated like this is not really by chance, but just by those algorithms trading the same way that they did back then. And that's why you can look at these charts and kind of make predictions about what might happen in the future as well, because those algorithms are trading based on these things too. So if we look at institutions, they're buying a record amount of puts and protection on their investments. So this exceeds what happened in 2020. This exceeds puts from 2008. It exceeds puts from 2000. So that's kind of worrying because it kind of blows it out of the water. The hedging right now going on at institutions is 3 times more extreme than in 2008. So you kind of have to think, like, what do they know that we don't know? Obviously, that's a huge bearish signal. One bullish thing you can pull out of this is usually when there's this many puts open in the market doesn't want to pay them out, so it'll move higher, stay flat. It won't crash and pay out just massive premiums on all these puts. But it is kind of worrying that the biggest investment institutions and banks are buying this much protection on their investments. It kind of indicates, doesn't kind of indicate, it definitely indicates that they're expecting a lot more pain than what we saw in June. This would definitely indicate that they're expecting it to go much lower because these puts were opened after that June low. And that's kind of worrying. This next chart, though, it correlates the put to call ratio. So what we were just looking at on the last chart, and it lays it over with the S&P 500. And as you can see, they have a line at 1.5 because that's really when you're having a huge disparity between puts and calls, and usually when that happens, the market will sway the opposite way. So you see the last time we spiked over this level was in March of 2020, and it actually lines up almost perfectly with the bottom of the market in March of 2020. And then before that, it was in 2019 when we had that sell-off when the Fed came out and wanted to raise rates from where they were at then. The market didn't like that at all. A lot of puts were opened, it spiked, and the market bottomed. And the same thing happened in 2018 when we had a little bit of trouble in the stock market. We had a pretty big correction. The put ratio spiked, and the market bottomed. So right now we're at 1.509, so we're just over that level, so it could definitely increase, but typically the market doesn't stay this low for a longer period of time, or at least the puts have to come out of the market. So the market could have a hard time breaching through the June lows while there are this many puts open. But that doesn't mean that the market won't go lower. It just means that while there are this many puts open on the market, it can be hard for the market to make that violent move downwards, and that maybe they need more people to start getting bullish, like we talked about in the beginning of the episode, before it can make that violent move to the downside. So this chart, it overlays average and median returns following the S&P dropping 20% or more. So we had that in July, so we're kind of sitting at the 2-month range. So basically what this is saying, that 2 months after that drop, the average return on the markets is 1% lower, and the median return is minus 2.34%. That's at the top. And then if you look at the bottom, it kind of it lays out every drop that it's talking about, and it shows the returns. So the only time there were actually positive returns following that big of a drop was in 1987. The market was up 8% 2 months later. And in 2015, the market was up 5.94% 2 months later. In 2020, it was down 5%, so that would be the most recent thing to compare it to. We did actually go lower from the beginning of September to now, but from July, we're actually still a little bit higher. So 3 months later, the markets are usually up, and that happens 57% of the time. But really what I wanted to point out is 6 months later and 1 year later. So if you look at the average for a year following this big of a drop, the average return is 17.68% 1 year after the market drops 20%, and that's even with it going lower following the 20% drop, and the median is 16.09%. And one thing I wanted to point out was that since 1987, 100% of the time after a market drops 20% or more 1 year later, the market actually is up from that point, that inflection point. So if you look at the most recent time that the market dropped that much was in 2020. 6 months later, it was at 18.42% higher from that inflection point when it went 20% or lower. And a year later, it was up 27.05%. So it actually recovered everything that it had lost and more. Obviously, looking back, we know that was because the Fed eased the economy. It pumped money into the economy. And that's kind of why we're dealing with this inflation problem now, was because of what the response was in 2020. But it's important to not get spooked out of the market. This is actually the best time to be a long-term investor. So when you see lower prices, you shouldn't be running from the stock market, but you should be looking at what you want to invest in and getting in at good prices, because over the long term, that's actually how you make money, and not by buying it when the stock market is going up, which is what a lot of people got caught in 2020, buying the market as it was going up higher and then freaking out because prices were inflated and the market has been coming down since then, and then they don't invest. But that's really, right now is really when you want to be investing. So I also have a chart here, and it is the NASDAQ following a day after every single member declines in the NASDAQ 100. So that's the 100 biggest stocks in the NASDAQ. And actually last week we had a day where every single company in the NASDAQ 100 went down. So similar to what we just saw on the last slide, it gives you the percent move from 1 week, 2 weeks, 1 month, 2 months, 3 months, 6 months, and 12 months. So if you're a long-term investor, you shouldn't really even be concerned about the 1 week to 6 months range. The thing I really wanted to point out was the 12 months later. So the median return a year later following a day where every single company in the NASDAQ 100 goes down, the median return after that day for 1 year is up 21.2%. So 100% of the time, a year later, since 2008, where we have a day where the NASDAQ has a complete drawdown, the NASDAQ is actually up 21.2% a year later. So again, when the market is scariest, that's actually your opportunity to make the most money. And it's hard because your brain doesn't want you to be putting money in when the market is getting slaughtered. But that's, statistically speaking, the best time to actually put money in. That's where you can get the biggest returns. When the market is moving down, your expected return actually goes up, because over a long period of time, the market returns 8 to 10% year over year. That's not saying that the market is returning 8 to 10% every single year, but the average is 8 to 10%. So if you're in a year where the market's down 20%, then your expected return for the next 9 years actually goes up. So when the market is down like this, that's actually when you want to be investing, as long as your time horizon is a couple years, because that's where you can make the most money. So we had this on the last episode, but I wanted to keep it in because this is the bond market kind of telling us that we're in a recession and that we're going to experience maybe a prolonged recession. We've talked about the yield curves and basically what that means. So, for example, the main curves that people look at is the 2-year and the 10-year. So when the 2-year rate is higher than the 10-year rate, then that means that they're expecting the Fed to raise rates higher in the short term, but have to cut them in the long term, which if you think about what that means that the Fed is raising rates, for example, right now to combat inflation, because inflation is out of control. but the market is expecting something to break or for us to go into a recession or an environment where the Fed's actually going to have to lower rates over the long term. So when a yield curve inverts, that's when the shorter term rate is actually higher than the longer term rate, because in an ideal economy, you want the market to be strengthening every single year, and you want rates to be able to go up steadily every single year to keep pace with that strengthened economy. But in our economy, it doesn't really work that way, because we have these huge cycles where the market is actually really bad. And so even though the market is really bad right now, the Fed's actually having to raise rates quite aggressively, the most aggressive that they ever have raised rates, because inflation is getting out of control. At the same time, our economy is kind of collapsing, and the outlook for the next 10 years is not good. So the market is saying at some point, you guys are going to have to lower rates or else something's going to break. And this charts out all of the yield curves in the bond market. And that red dotted line is at 55%. So when there are more than 55% of all of the yield curves in the bond market inverted every single time that's happened, we have been in a recession following. We have crossed over that threshold. We've been over it now for a few weeks. The U.S. government still has not announced that we're in a recession. Actually, when they're asked by the media, they insist that we are not in a recession. If you go off the textbook definition for a recession, which is 2 consecutive quarters of real GDP decline, we are in a recession. Also, if you just look to see what's happening everywhere, people are starting to lose their jobs. Now, the housing market is beginning to collapse. The stock market has collapsed. The companies are struggling with earnings. Earnings are starting to go down. We are in a recession. The government doesn't want that to happen because there's a vote coming soon, so that they're going to keep telling you that we're not in a recession, but we are in a recession. And the bond market is confirming that with the yield curves being inverted as well, and that's why I want to keep it on the video, so I can keep everybody informed. So this is the VIX. This is the volatility index. Usually it spikes pretty high following a stock market bottom, that like capitulation sell-off event. This is the blue line is the VIX from 2008. We were looking at the stock market from 2008. Now we're going to look at the VIX. And the VIX in the white is the VIX from today's or this year's market. So we still haven't had that huge sell-off or that huge spike in volatility. If you want to see a market bottom, typically you have to see it at least get near 50 or higher. In 2008, it went all the way to 80. Obviously, that was in correlation with a bottom in the market, but the market also went down a lot lower than we have so far. So the market actually went violently lower at the same time that the VIX was spiking, and then as it started going back down is when the market recovered. Obviously, it took many years for the market to recover, but it's really that spike in volatility that you're looking for. It can't stay that high forever, but the sell-off will typically be correlated with the spike. So that's kind of what you can look for if you're looking to see if a market is bottom. That's just another indicator that you can use. And if we do stay correlated with 2008, it would suggest that we still need to see some type of panic sell-off that takes us much, much lower. So we've been talking about this chart the last couple of weeks as well during our weekly wraps. This maps out every single bear market since 1835. It gives you the average and the median sell-off percentage. It also gives you the average and median time it takes to go from the peak of the market to the trough and the trough to the recovery. So basically speaking, the percent decline, the median, I like to look at the median because it kind of takes away any outliers and gives you like the true average, in my opinion. So the median sell-off in a bear market is 32%, and we haven't gotten any worse than about 21% on the S&P 500. The median amount of time that it takes back to recover to the previous level. So kind of like that peak to trough back to the peak is 39 months. The average is 60 because we've had some really bad bear markets. If you look at 2008, it took 55 months. If you look at 2000, it took 148 months. Some of the other ones were over 200 months. But the median is 50. It's 49 actually, but it's around 50 months. We're in month 9 of this bear market. So the typical peak to trough, so the peak of the market, which for us was in January, to the trough is 14 months. So it's a little over a year. Again, we're at 9 months right now. So that would also suggest that we're still not through with the selling in this bear market. And then the amount of time from the trough to the recovery point, so back up to the peak, is 11 months. So typically you'll see a year to recover. Sometimes it can be up to 2 years. But generally speaking, it is about 11 months. So yeah, this would suggest that we're still not really done with the selling, that there's still more pain to come. But again, if you're a long-term investor, it pays to just dollar cost average and put the same in every month or every week or however you want to do it. Don't try and time the market and put in a lump sum all at once, because most likely you'll get it wrong. And you'll get better returns, honestly, if you just dollar cost average than if you try and put that lump sum in, because no one knows when the market is actually going to bottom or how long it's going to stay there. So we've talked about this chart the past 2 weeks, and I'm going to keep it on for this episode because it's actually what's happening, and we said that this was most likely what would happen. So the beginning of actually, I'll back up a second. So historical trends suggest that late September is when trouble happens in the stock market. This doesn't have to do with a bear market. It doesn't have to do with a midterm election year. Just in general, from 1950 to 2021, this is the average return for the month of September. You can see that in the beginning of September up until the middle of the month, it's usually flat to a little bit higher, which is exactly what happened this year. And then from the middle of the month through the end of the month is actually when you start to see a lot of selling. So last week, which was the middle of September, we actually did see the stock market start to decline again a little bit sharply, and that would correlate with what we would expect to see in a normal September. But this chart charts out the average return per month in the stock market, and it overlays it with a normal year and then with a midterm election year. So with us being in a midterm election year this year, we can look to the month of September, which is right here, and we can see that in the beginning of the month of September, we're usually flat to a little bit higher, and then from the middle of September through the end of September into the beginning of October even, we're down quite a lot. And again, so this is a midterm election year. It's also a bear market that we're currently in, so we have to rely at least a little bit on some of these indicators, because there's so many synergies throughout them. When you start to see indicators flashing the same signal, you have to start to trust them a little bit. So we'd been talking about that the past couple of weeks, that maybe we could see a bigger sell-off in the middle to the end of September. Obviously, last week when the inflation number came out, that's exactly what we saw. The stock market went lower, and that would correlate with what we're seeing now. So in a normal midterm election year, what happens in the beginning of October? It usually stays flat, and then November and December in any year is typically a really strong 2 months for the stock market. So what could you expect from a bear market through October and the end of the year? Well, you'd expect a pretty big bear market recovery. So usually the biggest swings to the upside in a market is actually during a bear market. That's when you'll see those biggest swings upwards. So you could see a 15-20% move higher in the stock market through the end of the year, and then we could continue to stay in this bear market and come back down. That's what happened this summer. So we hit the bottom in June. We bulled quite higher on the stock market. After that, the NASDAQ was up 20% from that point in June, and then we sold back off again. So that's kind of what I would expect through October, November, and December. So I have this chart on here because we're still below the 200-day moving average, and eventually we won't be. So What happens when the stock market breaks back above the 200-day moving average? And typically that has been the beginning of a pretty big bull market, the only exception being in the 70s. And what happened then was kind of similar to what we're seeing now. Obviously, it was really bad inflation, but actually what happened is the Fed pivoted too early. So inflation started to flatten off and go down a little bit. The Fed pivoted, inflation got worse, and they actually had to go back into a tightened economy. So that's why this one stands out as being before a big market sell-off. And the Fed right now has mentioned that they're trying not to make that mistake again, that they're not going to pivot too early. They're not going to pivot till the job is done. And obviously the job is far from done because inflation is still 8.2% year over year. Their target is 2%, so to get it back down to there is going to take quite some time. So we could be ways away from breaking back above the 200-day moving average if they do what they say. So let's look at some charts now of stocks. So I want to look at Apple as we do every week because it's the biggest company in the stock market. If you kind of can understand what might happen in Apple, you can kind of predict to how the market will move. This is kind of like a market leader. So what happened? So after we had that huge market rally, we hit our trend line on Apple and started to move lower. Last week, we actually sold off through our 152 zone, the bottom of that zone, and we then came back up to it. So now we're testing it from the point of now it's a resistance. So you could expect some selling at the zone that we're at in Apple, and I would expect it to move back down to the 138 to 135 level, which was right above the June lows. If we breach through there, then the whole market will most likely be moving through the low that we saw in June. I do expect that the market will be really volatile after they announce the rate hike increase. If it's 100 basis points, I think the market could really swing down lower pretty heavily. If it's 75 basis points, honestly, I don't really know. It makes this kind of analysis a little bit more difficult, but I do expect it to be volatile no matter what it does. So that's kind of what I'll be looking at. But right now it looks bearish on Apple. I mean, it's sitting at a resistance point, kind of looks like it wants to come back down to that 138 zone that we have mapped out on the bottom. And it could definitely get some buyers there. But if it breaks through and breaches that low from June, then the whole market could definitely be headed for a new low. So let's take a look at the S&P 500. You'll notice that it is kind of correlated to Apple, to where we broke through a support level and now we're coming back up to test it as a resistance. So if Apple moves back down to that zone we had mapped out, I would expect the market to do the exact same thing, to reach this zone that we have mapped out on the bottom, which is right below 3750, so sitting around like 3700 to 3650. The market bottomed around 3660 in June, and it hit our channel line on the bottom. If the market breaches through this zone and breaches through its June lows, I would expect it to go back to the channel line. So that would be below 3,500. So that would be a really, really big sell-off from where we're sitting right now. I don't expect it to go any lower than the channel line. I would be really surprised if it went below the channel line, unless we got some other black swan event, something that none of us really saw coming. But even if the market or if the Fed raises rates by 100 basis points, I would still only expect this channel line to be touched in the event that we break through the June lows. But overall, I'm kind of bearish on the S&P 500 in the short to medium term. Obviously, it's still a good time to be a long-term investor. I'm still putting in the same amount of money every month, regardless of what my opinion is, because I have a long time horizon. And if you have a long time horizon, then it'd be good to be dollar cost averaging through all of these events and not letting anybody spook you out of investments. Because like we talked about earlier, real wages are decreasing. The amount of income that you can make from laboring is actually lower. And the only way to not have to do that anymore is to own assets that will pay you income instead. And when you own assets that pay you income, like stocks, if the value of stocks increase over time and you're making a percentage of the assets that you own as income, then you should be getting a raise when your assets go up, and it should outpace inflation. And that's kind of how you can break out of that cycle of needing to labor for income, is by owning assets that pay you income instead. So it's always good to be dollar cost averaging when assets are cheaper. Don't let anybody fool you out of buying that income, basically. So last but not least, I want to take a look at Bitcoin like we always do. Bitcoin has been in this range now for like 3.5 months. Like we're coming up on 4 months that Bitcoin's been in this range. And then that can be dangerous because we're in an overall bearish trend. And Bitcoin has a lot of room to fall if it breaks through that 17.5 level. So we've been talking about the 17.5 to the 17.7. That's kind of like my point of no return for Bitcoin. If it breaks through that level, there's nothing stopping it from going to the 9,000 to 12,000 level. I haven't mapped that out yet on Bitcoin. I will if it breaks through our zone. I'll map out where I think that could be. But in general, the 9,000 to 12,000 level is where Bitcoin will have any sort of stability or support if it sells off. And that would be that could be up to a 50% drop from where we're at already, which is minus 72%. So if Bitcoin falls that low, it would be a point in time for me that I would be loading the boat absolutely on Bitcoin. I would be putting as much money as I could into Bitcoin at that point. I've given you reasons why I like Bitcoin a lot, especially at a point in time where we're at right now, where banks could just close and not let you withdraw their money. Right now, stakeholders can't withdraw their money from Ethereum. Even governments are trying to move to have centralized digital currencies on a blockchain where they can surveil your money, they can censor it, they can take it from you, they can confiscate it, and you really don't have any ownership over your money. I think Bitcoin is really the only place where you can be your own bank. You can put it in cold storage. No one can take it from you. The government can't take it from you. The military can't take it from you. You can bring it with you in your head as long as you have your seed phrase. It's borderless. It's instantaneous. And if it goes to those levels, I'm going to get as much of it as I can. But it is looking bearish on Bitcoin price-wise for the short term. So I'll end with Bitcoin. I thank you for making it to the end of this video. This was a little bit of a longer one, but it was an important one. If you enjoy this video, be sure to subscribe here on YouTube and follow us wherever you listen to podcasts. But until then, I will see you in the next one.